Today's Q&A, Purpose Investment CEO Som Seif is with us to answer your personal finance questions. Welcome, Som.
Good to be here.
And our first question comes from Tony Imbrogno, who posted this question to Facebook. He writes, is it better to invest in dividend stocks separately or in a dividend stock mutual fund? Now, this was a bit of a setup because you don't really believe in mutual funds. You created a whole industry about the sort of anti-mutual fund. But let's just pretend that's not true for a second and talk about what we're talking about here.
Well, actually, I would say that ETFs and mutual funds, which is ETFs, is something that I think we believe heavily in. But we think mutual funds are also a wonderful tool. It's all about the cost that we really care about. So just to correct you there. So the question that Tony's asking is a really good one. It's one that a lot of people face, which is, do I just go and buy a bunch of stocks myself, dividend or non-dividend, doesn't matter, or do I go and buy, a fund that basically will manage it for me? And the reality is that unless you believe that you as an individual can pick stocks better than the market or better than professionals, and the last part maybe that's a question mark, but better than the market, you really shouldn't be trying to pick individual stocks.
Right.
But the second question really comes down to, do you have a sell discipline? And this is the challenge that a lot of people face. If you're going to buy individual stocks, Amanda, I just think that you got to have a sell discipline. You got to know when you're going to buy it and when you're going to sell it.
Yep.
If you don't have a sell discipline, it's very hard to own a stock long term.
Because you need to rebalance so that one thing doesn't get more sort of weighted in your portfolio versus another.
Well, and also because if you don't understand why you're buying it and how what ultimately your goal is with this, you're going to hold it through different periods, and then you're not going to optimize your return.
Yep.
Because let's say you buy a stock like the RBC, a great dividend-paying stock, let's say in Canada. Challenge is that let's say it performs for the next 5 years, and at some point it may not be the future performer.
Right.
And so when do you sell it? When do you know? And do you switch to another dividend-paying stock, or do you ultimately hold it? And most people don't have that discipline. Also, if it goes down, likewise the same thing. When do you know to sell it?
So the flip side of that, though, is I would say, although it's true, most people don't have either the discipline nor the time really to focus on this stuff. We'll get distracted and we won't rebalance properly. But if it's managed through a portfolio approach, so through an ETF, or some manager is making that decision, they don't know what my specific goals are. How do you know what's best for me versus another guy in the fund?
Well, it's not about, when you're buying a fund, you're really buying a strategy. You're buying the discipline of what the strategy does. So what's important whenever you're buying, whether it's a mutual fund or an ETF, which, it all comes down to 2 or 3 things. One is, how are they investing the money in the first place? What are the rules? What are the selection decisions? What's the implementation? 2 is, what are the costs? And really that's the big question mark ultimately. If you're paying too much for it, it's just not worth it regardless.
What's too much?
Well, look, in a dividend fund, my personal view, I don't think you need to pay much more than 0.5%. And I think there's fantastic products out there that are 0.5, 0.6% all in. And that's you can prove that in the market.
So let's say I said, okay, I want to do this on my own. What's the right number of stocks? If I want to create a diversified dividend portfolio of stocks, is it 20? Is it 30? Is there a magic number here?
Well, I'm a big believer in having some conviction in the name. So if you do too much, you're just going to look like the market. And so you want to probably have 20 to 30 names maximum in an individual portfolio. And in an ETF or a mutual fund, likewise, you don't want to buy something that has 70, 80 names because you're just going to look like the market with a lot of fees on it.
If I did opt for that, going at my own strategy, as an individual, I still pay to buy and sell stocks. Did my cost base end up higher than that 0.5 you were talking about?
Well, it really depends on the size. So if you're dealing with a $100,000 or less portfolio, if you're buying 20 positions, that's a lot of trading. If you're buying, if you've got $1 million or $5 million portfolio, a little bit less impact. Well, exactly, Amanda. Big payment at CBC. But the last thing I was going to say, one of the things about dividend stocks, and I'll just warn Tony about this, dividend stocks have a quality problem. They are value trades, and so you just have to think about littered with low quality businesses.
Right.
And so you got to know when you're buying it, don't just look at the dividend, look at the fundamentals of the business.
Not all dividends are equal, right?
Exactly.
All right, our second question arrived via Twitter. Martin Gray writes, I have 2 mutual fund retirement plans, one with work and one on my own. Should I add to my work plan to make a bigger pool of money? A lot of people actually go through this, especially if you're changing jobs. You might actually have a legacy plan, and then the question is, do you drag it along into your personal? What's your approach?
Well, here's my perspective. I actually think you should have your work plan, and you should have your personal investment portfolios, and if it's RSPs, TFSAs, other things like that. And you really should keep them separate. And the reason is because most work plans are, in fact, very inflexible. They don't have, they're run by the large institutions, the insurance companies for the most part. They often don't give you a lot of choice, and they're very expensive in terms of the fees that are underlying them. But most importantly, you can't withdraw your funds out of them more often.
Right.
Whereas the personal has a lot more flexibility.
And so in terms of wrapping them together, if you were going to do it, you'd have to find out what the rules are of that specific work plan before you know whether there's going to be a penalty. Is there a benefit, though, to having a bigger pool of money in one place, reducing fees, for instance?
On the personal side, yes. On the work plan, likely no, because you get the benefit of the whole work plan negotiation of fees coming down and all the rest of it. So you're pooled with, the other employees. So if you're in 20-person employee shop versus a 500-employee shop, it's two different things. You get the pool of all employees negotiated.
Is there any data on whether company-managed or company-invested plans do better than personal ones?
I have a really strong view on this, which is that the problem is that the programs are often offered, the defined contribution programs, and the problem is that many times they give them a lot of choice, and investors are often left with making that choice of what do I buy? Do I buy a balanced fund, an income fund, a dividend fund? And often when they're faced with that, without the right education, they just get put into a position where they make no choice. So a lot of these plans, people put them in money market funds. So they're earning very little, they're not making a great return, and they're not really, maximizing their opportunity. And so my view is we need more guidance in these programs to make investors more successful.
Som, thanks for being here.
Great to be here.
Som Seif is CEO of Purpose Investments. Coming up next, Russia signs a deal to resume natural gas deliveries to Ukraine and pushes up interest rates to prop up its sagging currency. Today's last word, we'll look at whether it's enough to rescue the Russian